Get off the sidelines and take control of your financial future at www.tackletrading.com. Get in the game.
Okay, so S&P near, 260 and below gets interesting for bullish setups, right? A VIX spike towards 30 makes short volatility trades very attractive. Okay, so when you think about bullish strategies, you can do a million different things, but the high volatility, if you want to use that to guide your strategy selection, typically you'd be looking at maybe selling puts or put spreads. Okay, so short puts and bull puts are the most straightforward way to capitalize on an oversold market with high implied volatility. Okay. Back ratio spread's a good guess, but a back ratio spread is a long volatility trade. So when the VIX is really high, back ratio spreads are really expensive. You usually want to do those when volatility is low. Okay. So in hindsight, anybody who entered bull put spreads, and I'm using SPY as our proxy here, but anywhere around 260, 265, 255, anywhere in here, if you were entering bull puts and you didn't get shaken out, I mean, you made money on this rebound, right? You made money. The VIX collapsing from 40 down to 15 also accelerated your rate of making money. So everything, I don't think it's going to play out the exact same way, right? But I definitely want to look for those kind of plays, as the S&P gets down towards the lows. If it does, I mean, I don't know. Maybe it'll go right back up and just chop around here. But like a rubber band, the more stretched this puppy gets to the downside, the more attractive and the more likely it is to bet it's going to bounce back. Right? Or I should say the more likely it is that it's going to snap back, which makes it more attractive to bank on that. Okay, so what could we do? Well, a simple approach is use SPY or SPX or RUT or IWM or some other index or index ETF and sell out of the money April bull puts. If you look at the time frame here, right now, March is only a couple weeks out. That's too close. Okay, selling 2-week options is a bit too gutsy. You want to be a little more conservative, get a bigger margin of error. For a naked put or bull put, you go out to April. So I think April is your optimal time frame here. Okay. And, what are you looking for in terms of your percentage returns? Well, it's kind of personal preference, but typically, we want around a 10% to maybe even 20% return. Okay. So if you're selling a $5 wide bull put, that means you want 50 cents to maybe 80 cents. If you're selling a $10 wide bull put, that means you want about $1 to $1.60. Okay. All right. So I'll build that out on one of these indexes here in a second. Let me give you another idea. Okay. You could also create a shopping list of market leaders. Those that maybe you're a bit disappointed you didn't act last time they pulled back.